Welcome to the Value Vault, separating headlines from high stakes.
So this week, we've really dug into quite a mix. We've got macro, U.S. politics, crypto, the whole lot,
Quite the stack of sources, yeah.
definitely. We've got Anthony Pompliano covering insights from his chat with Russ Vought, former OMB director, and also pulling in views from Jordy Visser.
Okay, Vought and Visser. Got it.
Then we jump over to Real Vision, Raoul Pal's crew, looking hard at the crypto market. Meme coins, the majors, that big Circle IPO story.
Circle was huge this week.
Absolutely. And we even have some sort of on-the-ground intel from the Bitcoin conference in Vegas via the Arch Public team.
Oh, interesting. From the conference itself.
Yeah, so the mission, as always, is to pull out the really crucial stuff, the core insights, to help you make sense of all these moving parts.
Okay, let's dive in. We should probably start with the big picture, right? The overall environment. Pompliano's coverage seems like a good place to begin setting the stage.
Yeah, sounds good. And the market mood he painted. Well, it wasn't exactly panic stations, but nobody was breaking up the champagne either. Kind of a mixed bag.
So not the best, not the worst.
Pretty much, it felt like the majors, Bitcoin and Ethereum, were holding relatively steady. But underneath that surface, there was definitely some pain, especially if you're holding altcoins or meme coins.
Right, I saw that. Some serious pullbacks in those areas.
Exactly. Significant hits there. But then you look at Bitcoin.
Yeah.
It's been chopping around in a range, what was it, like 103.5K to 105K?
Something like that, yeah. Pretty tight.
And Ethereum also holding its own, near that $2,600 level. So price-wise, for the big two, a relatively quiet week on the surface. But like you said, definitely some underlying shifts and stress building up elsewhere.
And Pompliano, he kicked off with something that really grabbed the internet's attention, didn't he? That very public spat between Elon Musk and Donald Trump.
Oh, yeah.
Yeah.
That was something else. He described it pretty vividly, didn't he? The world's richest guy versus the world's most powerful guy duking it out online.
He called it entertaining, but maybe not great for the country.
That was his take. Entertaining spectacle, for sure. But beneficial? Probably not. And of course, the internet did what the internet does.
Memes everywhere.
Instantly. Pompliano mentioned a few, like that funny image of Trump slapping a "bought it before Elon went crazy" sticker on a Tesla.
Huh, I think I saw that one.
And the comparison to the Drake-Kendrick Lamar beef, framing it as the political or maybe Republican version of that feud.
Right, the high-profile clash.
Yeah, and apparently David Sachs was caught in the middle awkward spot between two feuding friends. And then you had the Bitcoiners' perspective, like Jack Mallers, basically saying, who cares? Dollar's losing value anyway.
Just focus on the fundamentals.
Exactly.
Yeah.
It really shows how different camps just saw this whole thing through completely different lenses.
It does feel like maybe it's symbolic of something bigger, though. Pompliano and Jordy Visser later seem to touch on this deeper read of Musk's recent frustration leading up to this spat.
What was the interpretation there?
The idea that maybe it represents this realization that the really deep U.S. fiscal problems, the debt, the deficit, they're just maybe insurmountable through normal politics or austerity.
Ah, like even the smartest man, quote unquote, couldn't fix it from within the system.
Kind of. The thinking is maybe Musk went to D.C. hoping to tackle these big structural issues, realized how entrenched the problems are, and now he's pivoted back to just focusing on productivity, building things outside of government action.
That's a powerful thought, that the system itself struggles to address these core fiscal challenges. And that ties straight into Pomp's conversation with Russ Vought, right? Someone who's actually been inside the machine dealing with this stuff at OMB.
Exactly. They got into the weeds of the U.S. budget bill that's being debated right now.
And Vaught's main point seemed to be, this bill isn't the magic bullet for balancing the budget, right?
Not at all. He was very clear. It's necessary for certain things, but it's not a comprehensive plan to fix everything in one go. He talked about the political realities, the procedures. You just can't cram everything into one bill.
Like deep cuts to specific agencies or adding tariffs.
Exactly. He mentioned things like the Dogecoin cuts, that's their term for targeting certain bureaucracies, but explained those are planned for future fiscal years, like FY25.
Right.
Legally, they can't really be part of this specific bill being debated under these rules.
Okay, so the process itself limits what can be done in any single piece of legislation. That's important context. And he also took aim at the CBO, the Congressional Budget Office, and their baseline assumptions.
He did. This was a key point. He criticized how the CBO assumes expiring spending programs will just continue forever in their baseline projections.
But they don't do the same for expiring tax cuts.
That's the critical difference he pointed out. Tax cuts set to expire, the CBO assumes they will expire in the baseline. So when a bill comes along to extend those tax cuts, like the 2017 ones, the CBO scores it as a massive new cost or addition to the deficit, even if it's just keeping things as they are.
Vaught called that an artificial gimmick, didn't he?
He did. And using that critique, he argued that if you adjust for that CBO baseline assumption, even before you factor in any potential growth or tariff money, this budget bill actually reduces the deficit by $1.4 trillion over 10 years, according to their OMB calculations.
Wow. Okay, so the whole debate about whether a bill cuts the deficit or not really depends heavily on whose model and whose assumptions you're using.
Completely. It can make the whole debate feel a bit academic almost, especially compared to the fundamental productivity challenge Musk seems focused on now.
Yeah, arguing over scoring methods versus actually building things.
Yeah.
But Vaught also laid out what happens if this bill doesn't pass, right? The consequences.
Oh, absolutely. Very serious ramifications, the most immediate one. The debt limit doesn't get extended. And he stressed extending the limit isn't new debt, it's just the mechanism that forces this whole fiscal conversation.
But failing to extend it, that calls the full faith and credit of the U.S. into question. Major economic fallout.
Huge. He also warned about a potential 60% tax hike on working families if the current tax laws expire. That could easily push things into recession.
Ouch. And the Homeland Security funding.
Yeah, that was very specific. He said, without the border security money in this bill, DHS could literally run out of cash sometime around July. So very real-world, tangible impacts if they can't get this done.
It really brings it home. It's not just abstract numbers. And Pompliano noted something interesting about the debt limit debate itself, how the thinking might be shifting.
Yeah, he pointed out that strange bedfellow situation, Senator Warren and President Trump both suggesting maybe just getting rid of the debt limit altogether.
Why? What was their reasoning?
Their argument, apparently shared, is that historically it just hasn't worked as a tool to actually enforce fiscal discipline. And Vaught seemed to kind of echo that, based on his experience, questioned its effectiveness over the decades.
Interesting. Seems like a growing consensus that it might be more political theater than effective policy. Now, speaking of new ideas, they touched on bit bonds.
They did, briefly. That concept from the Bitcoin world, the idea of the government issuing bonds where maybe, say, 10% automatically goes into Bitcoin.
And what was Vaught's take?
He acknowledged the administration is shifting its view, seeing crypto, especially Bitcoin, more as real assets. He said these kinds of ideas are starting to percolate in policy circles, but he was very careful to say, bit bonds are definitely not in the current budget bill.
Huh.
Okay, so percolating, not implementing. Still, it shows how much crypto is entering the mainstream conversation. Drop a like and share if you find this valuable.
Definitely. And connecting Vaught's points on the structural fiscal challenges to Jordy Visser's analysis, that adds another really important layer. Visser had this simplified model of the U.S. economy.
Right, the three parts.
Yeah, he broke it down into the industrial economy, think Trump's base, debt-filled, slow growth. Then the digital economy, less debt, fast growth, and then the government economy.
And the key part of his model was that the government economy is basically unshrinkable.
That was his core argument. And why its unshrinkable ties directly back to Vaught's points about the intractable debt and deficit. Visser says the main driver is healthcare spending.
Medicare, Medicaid, that kind of thing.
Exactly. It's growing acceleratingly, maybe 8–10% a year, mainly because of demographics. An aging population just needs more healthcare.
So it's built into the structure of the population.
Precisely. Plus, Social Security demographics, more people collecting benefits. And he mentioned a fear factor, too, people claiming benefits earlier if they're worried about the economy. So his conclusion is pretty stark, and it really hammers home that print money by assets idea.
Because the government spending side, especially healthcare, can't realistically be cut enough.
Right. So the debt-to-GDP ratio, it's not going away. It's structural, baked in.
Wow. So budget fights aside, the underlying structure keeps the pressure on. Visser also talked about the recent economic data, which has been all over the place.
Yeah, that Q1 negative GDP print caused a stir, recession fears. But then Q2 forecasts, like the Atlanta Fed GDP now, shot up initially over 4%.
Suggesting a huge rebound. What was Visser's take?
More cautious. He argued Q1 was distorted by a big jump in imports ahead of tariffs, which pulls GDP down. Actual domestic demand was better, maybe 3%. And for Q2, he thought growth would be okay, but less than those high forecasts.
But his main point was, we're not actually in a recession now.
Correct. And the reason, largely because that massive government sector, particularly healthcare, acts as a floor. It prevents a really sharp fall off unless you have politically impossible cuts.
Okay, so the government size provides a buffer. What about jobs? He had a specific concern there for the second half of the year.
He did. Not necessarily mass layoffs from AI right away, but he thinks AI could really hurt companies' ability or need to hire new people.
Ah, slowing down hiring, not immediate job destruction. That's a subtle but important difference.
Crucial difference. So it points to maybe a slower labor market later this year. Based on all that, his forecast was for maybe modest but still positive 2–3% real GDP growth in the second half.
Okay, positive but not booming. And his investment conclusion from that? Yeah.
Very direct. Bonds. Not the play right now. It's stocks.
All in on equities.
Pretty much. He noted the rally's been very tech-driven so far.
Yeah.
Pointed to semiconductors, specifically Micron breaking out, tied to this huge build-out of what he called the compute thing.
Data centers, AI infrastructure, power.
Exactly. That whole ecosystem. He sees that as a very real investable theme. But he also stressed, for the overall market rally to broaden and sustain, you need small-cap stocks to join the party.
Need broader participation.
Definitely. And this all circles back to something both Pomp and Visser agreed on. They called it the single biggest intelligence test for investors today.
Which is?
Boiling it down to one core question: is the government going to keep printing money?
And based on the debt situation Vaught described, and Visser's model of the unshrinkable government, the answer seems to be yes.
That was their strong conclusion. Given the structural issues, some form of continued monetary expansion, high deficits, stimulus, whatever form it takes, seems almost inevitable.
Yeah.
So their advice was blunt. If yes, buy assets.
Makes sense, logically. They also touched on housing affordability. Big political issue.
Huge. And the worry is political pressure to fix housing could lead to more stimulus, which might push rates higher, even with all that debt. That's the bind.
The debt burden becomes crushing if rates rise too much.
Exactly. With debt at 120% of GDP and a 7% deficit. You just can't ignore the cost of servicing that debt if rates keep climbing. It's a real tightrope walk for policymakers.
A very tricky situation. Okay, let's pivot now. Focus specifically on the crypto market dynamics, pulling from the Real Vision discussions.
Sounds good. And they definitely echoed that theme we started with: tough times for alts and meme coins while the majors held up better.
They felt a shift in the market tone.
Yeah, a palpable shift. Trading memes, Solana stuff, it's gotten noticeably harder lately. There's this feeling that maybe that whole 18-month run of meme coin mania and Solana on-chain frenzy might be cooling off or entering a much tougher phase.
That feeling of exhaustion kind of leads into the big discussion they had about Pump.Fun, right? The Solana launch platform and the token rumors.
Exactly. The Blockworks report. $1 billion raise at a $4 billion valuation. And they really debated whether that valuation makes sense.
$4 billion? How did they break that down? Seemed low to some.
Well, yeah, if you just naively annualize their peak fee generation, which apparently hit levels that could annualize to $700–800 million, then $4 billion looks cheap.
But the key word there is peak.
Right. They were quick to point out those fees had been trending down recently, and they questioned how sustainable that peak revenue really was. They drew parallels to OpenSea, ApeCoin, Yuga Labs, where initial hype revenue didn't last.
So extrapolated from one peak year is risky.
Very risky. So maybe $4 billion isn't optically low if you assume a more sustainable, perhaps lower fee run rate going forward.
Oh, yeah.
Might actually be fair under that lens.
They also compared Pump.Fun to Hyperliquid, which was insightful.
Yeah, that was a great comparison. Hyperliquid is more like a daily use app, so something active traders are constantly interacting with. Pump.Fun is mainly a launch platform.
You use it when you launch a token or maybe use screeners, but you're not clicking around on it all day.
Exactly. It's a different engagement model. And Hyperliquid, even as an app, has seen these huge implied valuations discussed, like $20–30 billion, especially if you think of it becoming core infrastructure, almost like a chain.
So how does Pump.Fun's $4 billion stack up?
The thinking was, $4 billion looks reasonable if you value it just as an app or utility. But maybe it looks cheap if Pump.Fun has ambitions to be like a meme chain itself, capturing value at a deeper level. OSF, one of the hosts, figured if it launches, you get the initial hype pump, but then uncertain after that in this market.
And the market's reaction to the rumor? Meme coins sold off.
They did. And the narrative quickly became either this is the other side moment, the peak exhaustion point, or even some cynical final exit scam talk.
But the Real Vision hosts didn't quite buy that.
Mostly not. They lean towards interpreting it as people freeing up liquidity, selling their existing struggling memes to get ready to potentially buy the pump token.
So a temporary liquidity suck.
That was their main take. If the pump token does well, maybe that liquidity flows back. But there's a big risk if it flops or crashes after launch. Kind of like the other deed's NFT launch.
Which coincided with an NFT market crash.
Exactly. Then it becomes a net drain on liquidity. Everyone who sold to buy pump is now holding a losing bag, and there's less capital overall. So the recent price drops in Solana coins reflect this uncertainty and difficulty.
Makes sense. People are nervous, repositioning. Okay, so if alts and memes are struggling, where did they see opportunity?
Ironically, they felt Ethereum itself is maybe the easiest, cleanest trade right now.
Just long ETH.
Yeah. And they made a really interesting point. The whole ETH killer narrative. It feels the weakest it's been in maybe 2 years.
That is a big change, less competition narrative-wise.
Definitely. So strong bullishness on ETH itself.
Yep.
And they still expect a broader alt season eventually, likely led by ETH. So besides holding ETH, they talked about ETH beta trades.
Assets that tend to move with ETH, maybe even more.
Exactly. Amplifying ETH's moves. Identifying the best ones is tricky, they admitted. Maybe not layer 2s directly right now, but they mentioned possibilities like Lido, the staking protocol.
Historically strong correlation.
Right. Also layer 0, the interoperability play, and then maybe more speculatively Ethereum Classic ETC.
Oh, ETC. That feels a bit more out there.
A bit more rogue or memey, yeah. But they acknowledged it does have a history of making big moves, often lagging ETH rallies, and they also threw Aave into the mix.
The lending protocol. Why Aave specifically?
They kind of linked it to that broader theme of TradFi starting to put big valuations on crypto businesses, like Circle. Makes established DeFi protocols with real revenue, like Aave, look potentially undervalued by comparison.
Ah, the relative value play against TradFi metrics. Interesting. What about NFTs? Did they see potential there if ETH rallies?
They did. The reasoning was partly that Solana on-chain exhaustion, maybe traders are looking for something different, and also the resilience of the NFT community sticking around through the bear market.
So potential for rotation back into NFTs. Which ones?
They mentioned the usual suspects, blue chips like Punks, cultural ones like Milady, crypto dick butts, strong brands like Pudgy Penguins, Bored Apes.
The established collections.
Yeah. But then they did this really interesting deep dive comparing Reki and Doodles.
Okay, what was the comparison?
So Reki NFTs have a lower floor price, like 0.4 ETH. Doodles are higher, maybe 1 ETH floor. But the Reki token has a way higher market cap, fully diluted value, FTV, around $120 million.
And the Doodles token?
Much lower FTV, only like $24 million.
Wow, that's a huge difference, especially with the NFT floors reversed.
Exactly. That's what they said. Screams cheap.
Yeah.
It suggests for Reki, the market sees the main value or potential in the token, not just the NFT, which is different from, say, Pudgy Penguins, where both the NFT floor and the token FTV are high. Doodles looks like an anomaly where the NFT holds the value, making the token seem potentially overlooked.
So the value isn't always just in the JPEG. Sometimes it's shifting to the associated token. Fascinating.
Definitely shows how complex valuation is getting in that space. And this whole discussion about valuation, especially comparing crypto valuations to TradFi ones, brings us right back to Circle and connecting the Pompliano and Real Vision threads.
Yeah, the Circle IPO was impossible to ignore. Huge event.
Dominated the week. Real Vision recapped the whole valuation journey, started with Ford Ball UB rumors, IPO'd at $6.09 beats, then immediately traded up to $13.14 market cap, doubled on day one.
Incredible demand. What was the analysis on why?
Core idea. Circle is the first big, pure-play, stablecoin narrative investment for TradFi. It's a unique story for them.
And the stock market values that story higher than the crypto market might value similar activity.
That was the observation. Higher valuation relative to fundamentals compared to, say, how crypto might value Tether's profitability or even Alive's lending revenues. Circle's regulatory clarity as a U.S. entity, its relatively defensive business model compared to cyclical exchanges like Coinbase. TradFi pays a premium for that.
So much so that buying Circle stock in a future bear market nuke was floated as a potentially good play.
Yeah, the idea being its TradFi valuation might hold up better. And this difference really highlights why Circle's IPO was viable. But maybe something like Pump.Fun isn't, right?
Easy story versus hard story for traditional investors.
Exactly. Stablecoins for payments is understandable. 4chan for memes, launching tokens. Much tougher IPO pitch.
Which points to that broader theme they both discussed. A coming crypto IPO season in the U.S.
Yes. Circle's success is a huge signal. They listed potential candidates: Ripple, Kraken, Uniswap, MAV. big names.
And the drivers are adoption, exit opportunities for early backers, maybe increasing regulatory clarity.
All of those factors. But they also flagged a major hurdle: those offshore token foundations holding massive treasuries.
How does that work with the US IPO? Seems complicated legally and for valuation.
Very complicated. The ApeCoin Yuga Lab situation, where there's been talk of maybe dissolving the foundation and bringing the token ownership under the main company, was mentioned as a potential blueprint. How others might try to solve that structural issue.
Okay, so a potential path, but complex. What about the immediate impact of these IPOs on crypto prices, like Bitcoin?
Real Vision noted Circle's IPO didn't immediately pump BTC or majors. It might even be a short-term liquidity event.
Meaning crypto folks selling crypto to buy the IPO stock?
Potentially. Crypto natives, early
What?
investors, selling some holdings to get into these new equity plays. There's even this emerging narrative: own Circle, own Bitcoin. For TradFi, Circle stock is seen as proxy exposure.
So maybe a slight short-term drag on crypto prices as capital shifts?
Could be, but the long-term view, overwhelmingly bullish. These IPOs bring in massive new capital, attention, legitimacy, and crucially, for Circle to grow, it needs more chain usage.
Transactions on Ethereum, Solana, etc.
Exactly. So growth in the TradFi-friendly corporate layer ultimately drives demand for the underlying crypto infrastructure. Long-term positive feedback loop.
Makes sense. Drop a like and share if you find this valuable. Helps others find this deep dive.
Absolutely. Now let's shift to that additional spotlight: the Bitcoin Vegas conference insights from the Arch Public team.
Right. They were actually there on the ground. What was the vibe?
Incredible energy, apparently. Huge global crowd. Vegas was completely taken over, felt like a giant slumber party,
Yeah.
but with serious talks happening.
And they mentioned seeing politicians, Secret Service.
Yeah, tangible signs of mainstreaming. It wasn't just the hardcore crypto crowd anymore. Definite shift.
What were the key messages coming from the stage?
Two narratives dominated, according to Arch Public. First, stablecoins. They estimated the word was mentioned like 6,000 times.
Oh, wow. Massive focus there.
Shows how critical they're seen as that bridge to TradFi and global utility. The second big theme: Bitcoin treasury companies. Corporations adding BTC to their balance sheets.
What's the appeal being pitched to companies?
Hedging inflation, preserving cash value. And for smaller companies especially, even a small allocation like 10% could potentially give a really disproportionate boost to net revenue if Bitcoin appreciates. Practical benefits. They really framed the story for 2025 as crypto moving into traditional equity markets via IPOs. They saw examples like Nakamoto, apparently a 27x jump from pre-IPO to trading.
That's insane. And Circle doubling instantly.
Exactly. Shows the massive TradFi appetite for this kind of exposure. It explains why companies are pushing for these listings.
And Arch Public argued these crypto companies are actually reviving the IPO market.
Yeah, exchanges, stablecoin firms, projects, Bitcoin treasury companies. They're bringing life back to TradFi IPOs, which they said have been pretty dead for maybe 35 years.
And the long-term impact of that.
The industry gets awash in new capital from public markets. Companies get stock to use for acquisitions, like Coinbase did. Fuels consolidation and growth, funded by TradFi money.
They also mentioned reverse SPACs or RTOs being popular.
Yeah, reverse takeovers, where maybe a struggling public company pivots its whole story to crypto or Bitcoin treasury, and its stock pops just on the narrative change.
Kind of ironic, since RTOs used to be seen as low-quality deals in TradFi.
Exactly. Now it's highly sought after in crypto. They mentioned seeing deals starting at $1, suggested this trend might last longer than people think because capital flow seeking equity exposure is so strong.
What was the single most repeated investment message from the stage?
A direct challenge to old models.
Yeah.
The 60-40 portfolio is dead.
Heard that one before, but it's becoming mainstream now.
That was the feeling. The argument being pushed hard was investors need a baseline allocation, often cited as 5%, to Bitcoin for better risk-adjusted returns. It's not niche anymore. It's presented as essential portfolio construction. The switch flipped in TradFi thinking.
And seeing figures like Ross Ulbricht on stage, that feels like a real marker of progress.
Huge sign of adoption, yeah. And they describe TradFi people, newcomers, just begging to learn more. Palpable curiosity. Felt like real progress towards the mission.
What about their own product at the conference? Arch Public Bitcoin.
Huge success, apparently. Great feedback. People liked its ability to generate cash yield, even when Bitcoin's just chopping sideways, through active management. It's user-driven, customizable.
And the demand was strong from corporate treasuries.
That was the striking part. Significant interest from actual companies wanting automated tools to accumulate Bitcoin. It's kind of a reverse of the usual flow, right?
So,
Usually, institutional tools get built first, then maybe trickle down to retail. Here, institutions are realizing they need the kind of automated, user-friendly accumulation tools that retail often had access to first.
That's fascinating. Institutions playing catch-up on tooling. They gave an example.
Yeah, like a small business, say a plumbing company with 400K into Bitcoin, with these tools could seriously help them expand or get loans, maybe more easily than a giant like NVIDIA.
And lenders are actually looking for businesses with Bitcoin now.
That's what they're seeing. Debt capital providers are actively seeking deals where the borrower holds Bitcoin.
Why? What's the appeal for the lender?
Instant liquidity is one thing easier than seizing real estate. Plus, sophisticated lenders are starting to understand the 4-year cycle, maybe feeling more comfortable holding BTC themselves if needed. It's changing how lending deals with Bitcoin as collateral are viewed.
Interesting. Follow us on Twitter @SnippetLabs for more updates as we track these trends.
Okay, let's try and weave all this together. The big picture.
Yeah, synthesize it all. We've got crypto's internal shifts, alts versus majors, memes cooling, NFTs DeFi potential, stablecoins rising.
Right, happening at the same time as this massive acceleration of TradFi intersection IPOs, corporate treasuries adopting Bitcoin, the 60-40 model being questioned.
All playing out against that backdrop of U.S. fiscal reality. Huge debt, the budget debates, the likely need for more printing Vaught and Visser laid out.
Plus the whole AI technological acceleration impacting jobs, data, everything.
So that core thesis, print money. Yes, buy assets. It feels even stronger after hearing Vaught and Visser on the structural challenges, doesn't it?
It really does. The pressure for continued monetary expansion seems almost baked in, regardless of the politics.
And this ties into the concern about economic data reliability, inflation, jobs numbers.
Exactly. Visser mentioned even economists are questioning if these old metrics, developed decades ago, can accurately capture value in today's digital AI-driven world. How do you measure GDP properly now?
Big question for markets that rely on that data. The U.S.-China dynamic was also in the background noise.
Yeah, things like rare earths, tariffs, it pushes supply chain shifts, maybe accelerates the AI race too. And that links back to Visser liking those physical tech intersection assets, semis, power, nuclear.
And within stocks, that challenger versus incumbent idea, Circle, maybe AI infrastructure players outperforming the Mag 7?
Potentially. A sign of where growth and focus might be shifting. But despite all the headwinds, the underlying bull market technicals like advanced decline lines, credit spreads, they seemed okay.
Yeah, resilient. Retail buying the dip was highlighted as a key support, maybe contrasting with institutional caution.
And Visser floated that idea of potential capital controls talk coming maybe before summer.
Not necessarily tariffs, but other ways to keep capital in the U.S. market. Could impact different investors differently.
Pension funds versus sovereign wealth, perhaps? On the human side, though, there's that real anxiety about AI and jobs that Pompliano and Visser mentioned.
Worry about the future of work, even amidst the investment opportunity in the AI build-out.
It's a dichotomy, and Visser's advice was practical. Start using AI yourself, in your work, your decisions. He called it an asymmetric impact tool.
Low cost, potentially high leverage for understanding things or brainstorming.
Yeah, use it as a sounding board. Subscribe to the Snippet Labs YouTube channel.
Follow us on Twitter @SnippetLabs for more updates.
And drop a like and share if you find this valuable.
So, wrapping up, the final thought to leave people with. Given all this, the speed of AI, the maybe shaky economic data, the structural shifts towards digital assets, the questioning of old portfolios.
What does it even mean to be well-informed or financially secure today? Is the biggest risk now not just missing gains, but actually misunderstanding these fundamental shifts in how value gets created, measured, and stored?
A deep question for a rapidly changing world. Markets move fast. Pinpoint your next profit window and seize the moment.